So, since we are talking about the lending business, specifically how risk gets involved and how it plays a crucial role. So, it would be better if we start a little bit with the history of lending and how it has started, and then we will be covering that how basically it is currently functioning across the globe, uh, basically from where any institution gets money, and finally how it lends, and finally how the whole money rotates. The entire lending business is in a way money rotation business. You take money from someone as an institution, lend to someone else. Once that person repays, then you basically try to repay to the investor who has given you the money. So we will be covering that in detail. Post that, we will be mostly talking about how basically different kind of businesses currently you would have heard, many of you would have heard about new businesses, new fintech, new innovations which are coming, how it is different from traditional banking business, and again, what are the benefits which different kind of lending institutions, especially compared to traditional fintechs, are having the better opportunity, or even there are many attributes where you will get to know that banks or financial institutions have far better in a way opportunity. So we'll be covering that. Then we will be going in detail about a few of the innovation which helps fintech run their business. And post that, we will be covering how basically one can measure their credit risk, and how any new company or any fintech evolves in their decision making. So these are the major topics which we would like to cover in the session. In addition to that, we will also be covering that what are different kind of risks and how it helps in general. And it's not just only credit risk which causes any company damage. One risk interacts with many other risks, and finally it converts to credit risk. So we will be covering that aspect as well with some example. Let's go to the next slide. Yeah, so as we were discussing, I think we have covered that. Let's go to the next slide directly, Mahima. Yeah, so the chart in the left, if you can see, we have I've covered that about the current form and shape of the lending, but lending is one of the oldest business in this entire planet. It had taken different kind of shapes. If you will see in a way properly some kind of written proof regarding that, then we need to go back to around 16th, 17th century, the current shape and form, where it was most of the lending was happening between a slave and their owner. So there was a huge culture in European market at that time, that there was a slave who used to work for different kind of owner. So how that lending used to work is there was an owner who has lots of land. There are multiple slaves who are working for them. The owner used to provide them different kind of lands for lending, as well, sorry, for doing agriculture. Also, they used to give the cattles, seeds, and everything for basically doing agriculture. Once the agriculture products used to came out after the cultivation, the slaves used to get the foods for their future. So that is the first start of, in a way, lending scenario, where the owner is lending their equipments and everything. And after that, at the same time, the slaves were offering their labor, and finally getting in terms of the food or crops which they are producing. So the first form is like that. Post that, the invention of coin came, and through that, this entire business has started taking shape. Uh, the After that, in 19th century, things have started little bit. Sorry, in 20th century, things have started little bit in data farm driven, which you see currently, where people started collecting different kind of data, although in a very crude shape. But with that, they wanted to take the decision. One of the major invention happened in and around 1950s when where FICO, which is a company as well currently, Fair Isaac, these are the two mathematicians who basically devised the first credit score. So in general, what is the credit scores? It provides the future forecast of someone is going to repay the loan or not. If I am giving somebody loan today, then after some X time, let's say 30 days or a year, the person will be able to repay me or not. So that credit score is in a way forecast of that. It is created in an index format so that everyone can read it. It's in FICO score or any CIBIL score you would have heard. You might be aware that it takes value between 300 to 900. Higher the score, better is the person's capability to pay. Lower is the score. There is high chances the customer who is taking the loan will default. So that's in general, which in a way the most recent invention which happened in 1950s. After that, there are many new launches or shapes came like in 1950, 58. You might be aware about American Express. They launched their first credit card, plastic card, where plastic cards are nothing but the BNPL, which you would have heard of in the current market. So even with credit card or initial plastic card, which were been given, one can purchase something and after 1 month they need to repay. The similar shape and form exists right now as well. Rather than the plastic card, it is more in automated fashion, where you can go on any website and probably the product is also added and you can purchase something. But that shape has still remained the same. Uh, After that, there are many new things which came because many of the countries wanted. Uh, so why lending is important? In general, lending is very important because it drives growth. So, for example, you want to do even cultivation or any business itself. At that time, you need money, but probably you do not have that. If from your country or from any of the bank present in your country, you are not able to get that money at right time, you will not be able to do your business. So that is one of the levers which most of the countries realized, and then they wanted to have a very easy accessibility of money or in a way credit. That's why you see in US most of the innovation has happened in the start, and US is the one of the country where credit accessibility is easiest compared to any other country. So to handle that, there are many new provision which also needs to be made by the government or regulators, in this case, Federal Bank of US. And what are those regulations? So there are many, in a way, racist or sexist rules which were present while decision making in lending in the start. When I say start, prior to 1970s, many of the companies had rules, for example, that if you are a black US citizen, then probably I will not be giving you a loan. Similarly, if you are female, then I will not be giving you a loan. So those are those very bad practices in a way suppress a huge part of the society. Because of that, the regulators or governments interrupted in such kind of doing business, and then new regulations came, which is called fair lending policy in US. The first form came in around 1980s, where it restricts using any such attribute while thinking about anyone and giving them loan or not. So you can't use those attribute while assessing anyone's loan eligibility. You can see similar scenario in India now also coming up, some time back, Reserve Bank of India has mandated to all the banks or all the NBFC, if somebody is applying for a loan and if they are getting rejected, then bank has to explain the reason, 4 or 5 reasons why they have been rejected. Previously, it was not very mandatory. The new regulation have just come. And those in a way reasons should be very valid. One cannot be used like since you are a, let's say, citizen of X state, or you belong to Y gender, then I will not be giving you a loan. Those kind of rules are not at all permissible. So this is in general about brief. This current century, 21st century, is has taken lending into altogether different space. Why it is possible? Because if you will see, in general, IT revolution happened in and around 1990s to 2000. Because of IT revolution, data structuring and capturing has improved a lot. So once companies are able to gather information or capture that data in automated fashion, then that enables the companies to take automated decision and don't delay in overall processes. Also, this data element enables the capturing of this data elements enables you take decision about customers present in any kind of geography. So, for example, in the previous brick and mortar format, probably if let's say SBI is present in only Bombay, then only Bombay people can get loan. But now with the presence of data and automation, anybody can apply from any corner of the country and they can get loan. So basically, IT revolution followed by capturing of data has helped the current shape of fintech lending, or even banks have improved a lot in their way of operating and way of, in a way, time taken to give somebody loan or not give the loan. I mean, the foundation stone to that revolution is actually IT revolution. So yeah, that's about the current state. Mahima, we can go to the next slide. So, as I was explaining, I just wanted to give little bit brief that how overall banking system or any financial institution who are part of lending works. So, let's just see the central part. Let's assume that the central part is bank. Uh, Bank is nothing but, in a way, intermediary. It gets investments or money from different kind of investor. In this case, investor can be me and you as well. So when you open any kind of saving account with the bank, you are in a way investing your money to the in the bank. And that is in a way investors. So there are different kind of investors. Me and you are called retail investors, but there are many institutional investors as well who invest in such kind of bank. So basically, banks are getting money from different kind of investors, either retail or institutional investors. Bank is aggregating that entire money, uh, then keeping some money for day-to-day business. For example, if you have a saving account, probably tomorrow you might want to withdraw some amount. So whatever money you have invested or kept in your saving account, bank cannot use that entire money and lend to somebody. So generally, banks forecast that what is their average spend of the customer, and they preserve that capital, and remaining capital they try to lend it somewhere, because when you has invested, you are also looking for some kind of interest. If bank is keeping that money with itself, they can't earn interest from anywhere. They also have to invest it somewhere. So for bank, lending is one kind of investment. So in this example, you can see that the bank is lending to another borrower who is using that money for some kind of purpose, maybe building some business, or maybe let's say for education, or maybe purchasing something essential, maybe buying a house, buying a car. once that money is there, then with the help of earning which they are getting through that, they are repaying to the bank. Once the banks are repaying, the banks gets additional money, and whenever the investor wants that money, they repay that money to the investors. In this case, if you will see, bank is giving money to the borrower, right? So that is in a way, money has become commodity. If you are selling somebody anything, you try to charge some price to it. Let's say you are selling uh, a pen drive. If you make it at 50 rupees, you will sell it at 60 or 70 some rupees, right? So that additional amount is in a way price which you are charging to the customer. Similarly, when bank lends to someone, let's say it lends 100 rupees to someone, so they are in a way money as a commodity selling to the borrower. So borrower has to bear some kind of price on that, and then and that is what is called the interest rate in this case. You would have heard the term interest rate or APR, these kind of term. So borrower has to bear that cost and return back the cost as well to the customer, to the bank, and finally some part of that money is being kept by bank, which is basically enabling that entire transaction for their maintenance and for them to run as well. And the remaining part, in this case, let's say bank is giving you 3 to 4% on your saving account, but when it lends, they lend it at 14-15% amount on an average. So that 14-15% minus 3-4%, that around 10% banks keeps for their own functioning, uh, giving it to the salary for their employee, maintaining all the infrastructure for all those things, right? So that is how that entire money movement or lending activity works. Now, if you will see, the money is moving from one hand to another hand. In this case, what can happen? Any one of this party can default and may not be able to repay. For example, the borrower may not be able to repay to the bank. A bank may not be able to repay the investors. So, because of any reason, maybe the customer had health issue, or the business which he or she was in was not able to give him or her the proper ROI, and they have to shut the business. So in that case, borrower will not be able to pay back to the bank. And similarly, if let's say it's only one customer and one investor, then in that case, bank will also not be able to pay it back to investor. So that chances of not getting money back is called credit risk in simple term. uh, where I am giving credit to someone, and that money is not going to come back to me. That is the risk with which I am living with. And but at the same time, any risk rewards you as well. Since I'm ready to take that risk, if borrowers are repaying me, I will be earning the interest on the top of it as well. So yeah, so that's in general the bank's functions, and that's how banks or any financial institution or lending fintech, that is how it works, and money movement happens in crude way. There are many other nitty-gritty which I will not be covering here. We can go to the next slide. Since the topic is risk, so it is important to understand that it's not one risk is not very independent as in nature. There are more than 50 different kind of risk categories which are defined by different kind of financial institution or regulators. When I say regulators, it can be like RBI, SEBI, those kind of institutions, and also financial institution. You can take any bank or any of the NBFCs, or any of the mutual fund players. All of them are in a way financial institution. So I will be starting from the fraud risk. So fraud risk is nothing but in the start only, the borrower who is taking money had a bad intention, which they do not want to repay. They just want to, in a way, gimmick you and take the money and go away. So this is core in a way intentional risk, which becomes very difficult to forecast and is one of the biggest challenge in the current financial institution or data-driven approach. Let's talk about credit risk. I think I have already explained the credit risk, how what is actually credit risk when you are paying to someone, lending to someone, and the chances when you don't get the money back. That's the one of the second kind of risk. Uh, there are many other kind of risk. Let's say an event risk. What is event risk? Let's say because of any scenario, a new event has happened. Let's take the very recent example. COVID has come, and many of the institutions have seen huge losses. Financial institution. Uh, Although one can categorize it's a credit risk, but it was not actually credit risk. The COVID event which has happened, because of that, many persons' business has gone, or many people have lost their job. So now, since they do not have money, it's difficult for them to repay, and so you can clearly see that one event is interacting with credit risk. Certainly, the bank who have lent to the customers or businessmen, they are not getting back the money. There are many other risks like sovereign risk. You would have heard about Pakistan many times that Pakistan is not able to get the money from IMF. So IMF is also in a way financial institution who lends to different kind of governments. So IMF is not trusting Pakistan government that when I will be giving them loan, the Pakistan government will repay me. So that's in a way one of the sovereign risks which the country is facing. Uh, Another risk can be currency risk. If this is this happens if you are doing business across two geography. For example, I'm doing business in India and US as well, and I'm, let's say, taking loans on dollar, but I'm doing business in rupees. That's the one of the major issue which has happened with Anil Ambani case. So Anil Ambani got loans at very cheap interest rate, but he got the loan in dollars. What happened at that time? That the dollar appreciated, meaning for $1 now the one has to pay, let's say, 80 rupees. But when he took loan at that time, $1 used to cost 40 rupees only. So although his interest rate was 3%, but this fluctuation, 20, 30, 40% currency fluctuation led to him to default on many kind of Chinese or US investor. Generally, that's why most of the companies who do business try to take loan from the same geography, because that currency risk goes away in that case. The next risk, and again, Anil Ambani was not able to repay to their lenders, and that finally translates to credit risk as well. Policy and regulatory risk is nothing but tomorrow, if the country is changing any new policy, or your regulator, in this case RBI or SEBI or any such institution, is changing new policy, because of which probably you are not able to do the business. Or for example, you can see again during COVID case that many of the banks gave moratorium because RBI and government institute in a way insisted. So when during moratorium, nobody can charge the interest to the customer. So at that time, the financial institutions actually lost all the interest earning which they could have got, and finally that again translates to the company earning. The example which I'm taking over here is one cannot just think that credit risk is one independent event. Although most of the analysis and forecasting which is done in the current ecosystem is for smaller financial institution is mostly focused towards independent credit and fraud risk assessment. But for any of the big banks, like in this case SBI or ICICI or Axis, these companies, when they assess any kind of basically their risk assessment, they have to go with all these processes, and then only they can say that this is overall risk which I am going to face. So the idea of this slide was one should not be thinking credit risk as an independent scenario. One risk actually interacts with another risk. One of the very important example, which probably you will see, and it is a huge PhD thesis topic, is how environmental risk is going to impact my company, or finally in turn in terms of credit risk. So, for example, just think about me. I am lending to business owners or to business. Let's say Chennai got flooded some time back. Many of the businesses would have gone for a toss. So those guys will not be able to repay me. Uh, One of these kind of floods and different kind of scenarios happening due to environmental change. So one cannot say that I mean I can assess credit risk independently and I can stay in peace. They have to be very open and think about the overall global and even environmental scenarios, that how it will impact my company or my policies. Uh, since you have learned about risk, I just wanted to give you brief little bit how any of the lending companies journey starts. Uh, uh, Probably many of you would like to do your own start your own company or start your entrepreneurship journey, so it might help. Generally, any new financial institution who are not coming from big corporate house, in turn who do not have lots of money, generally they start lending at small amount and small tenure loan. Why it is important, small amount or small tenure loan is, let's say if you have 100 rupees only, and you are keeping only 30-day period, then you can just give somebody 100 rupees. After 30 days, they can again repay. You can lend that money to another person. So the same small amount of money is rotating. You don't need a lot of money. On the other case, if let's say your tenure goes to 3 years, you will have to wait that entire 100 rupees to come back in 3 years. You can't basically have opportunity to re-lend that money because it is still stuck with the consumer who will be paying you with their EMIs. So it becomes very important for new companies to start small and with smaller tenure, because money movement becomes easy and you can serve more customers. Once that is done, then obviously they scale up to more customers and see how their business plan and strategies are working. Once these parts are set, probably as a company, you will also get more money from different kind of investor. People will start trusting you. So then you can start testing with different same product with higher tenure. Meaning previously probably you are giving loan for only 1 month or 2 months or 3 months. Now probably you want to give customers for 3 years to 5 years, 10 years, something of that sort. Once you reach to that stage, generally it is advised to the companies that once go for profitability check, that whatever you are giving money, are you getting it back or not, and are you earning interest on that? That overall you are profitable in nature. If you are not profitable in nature, then after some year, one suffers, and many of the companies has to shut down. Uh, and obviously, once these scenarios have happened, it is a normal thing that companies should be launching a new product. Why it is very important is, again, probably I missed one of the important risks is called concentration risk. If you are putting all your money in the same basket, if because of any reason that business gets negative impact, then your entire money can go off. That's why it is advisable to the companies that try to venture into the new product segments as well. One of the similar scenario, if you will see in FREO, we have started with one lending product, but now we have scaled with savings product and business loan as well. Previously, we were only giving to consumers. Now we are giving loans to business. We are also giving different kind of insurance options to customers. So as a company, FREO is also diversifying over here, so that we don't face any kind of concentration risk. And again, if you have a different product which you think is in a way covering you from different kind of concentration risk, then actually you have to scale up all kind of product which you think are very important. Maybe you will be trying 4 or 5 product, one of them is not working, and you are not able to see product market fit. Then probably you want to discontinue it and scale other products. So this slide is little bit more detailed, but it is very important because uh, we wanted to cover in this session that how different companies are coexisting and what are the benefits of different companies, and why they have actually natural alliance as well. So if you would have seen in the recent phenomena, many of the existing companies who are in some different venture are trying to get into lending. For example, Flipkart started PhonePe, PayU started LazyPay, uh, and many such companies who are actually starting this. So in general, when you do business, to acquire customer, you have to do marketing, and that marketing cost is not small. It actually comes around 2 to 5% of your overall business. So if you will see, any e-commerce have already a big e-commerce have already their distribution channel sorted. For example, I was working with Ola. For Ola, the this cost of marketing was almost zero. Whoever is coming over there to take a cab, the Ola was sending in a way selling the loans as well to the customers. So they do not have to put additional money for different kind of acquisition. When I say distribution channel, it's nothing but from where you are acquiring the customer. For banks, it's still a little bit difficult. One can say it is second best. Banks have to, they are still in brick mortar method. They have rarely automated the way, but at the same time, since they are historical players, they have most of the customer. For example, at least the people who are, let's say, born prior to 90s, most of us have one account with SBI, although it might not be active, but certainly we had opened one of the account because that is one of the biggest player, and it has huge coverage in the country. So in a way, most of the people who are born prior to 1990s have some kind of account with SBI. For new player, it becomes difficult. In the start, they have to fight a lot. They have to create some kind of branding. Once the branding is created, then the cost becomes very easy. That's why you probably would have seen that many of the companies invest a lot in branding. They give ad on television. They show different kind of ad. They show trust and all those things. I don't know, probably if any one of you were following FREO or MoneyTap, we also had done lots of branding in the start. Now our cost of acquisition is very, very low compared to any new player. Then for lending, it becomes very important that you know your customer. I have just talked about fraud risk. If you don't know your customer, then there is high chances that you will see hell lots of fraud. So again, when you are doing KYC, it becomes tedious journey for customer as well, and it costs you because you need to send somebody to collect data and all those things. So again, for e-commerce, probably they are already delivering stuff to different places. So they already know where customer lives. The KYC doing KYC becomes easier. For banks, it's still very, very manual. But if they already have many customers, then it is least. For new players, it is generally high. And this is also in a way regulatory requirement. You can't give loan anybody if you don't do KYC. Uh, let's skip the servicing part for now. It's nothing but in a way your tech cost and all those things. Cost of fund is nothing but, as I was explaining before in the previous example, like the interest which you as a financial institution paying to your investor. So for banks, let's say you are opening the saving account with bank is paying you 3%, 4% interest, or maybe 5, 7% as well. That is the interest. That interest is in a way cost for bank. So for banks, generally it is the least because they have huge current account, saving account pool. For any other player, it becomes little bit high in nature. Again, repayment is nothing but when you are repaying the loan at that time, also different parties get involved, and there are many kind of challenges over there. Collection is somebody default, and they try to fight and try to reach out to customer. They call and they basically try to reach out to the customer and try to get the money back. So there are many other costs. If you will see cost of bureaucracy, that's highest in bank. They can't change anything without thousands of approvals. Again, also operational cost. I'm sorry, probably the slide is not properly updated. Point number 9, it is in a way OPEX is at scale is lowest for uh, any fintech player or e-commerce. But for bank, it's very high because they have to open different kind of physical branch. They have to be present. Money gets involved in all of that. In general, if you will see fintechs or e-commerce who are trying to get into fintech, they have a huge advantage over there. Generally, OPEX for bank is around 6 to 7%, meaning the real estate cost, the salary cost, and all those things are around 6 to 7%. But for a fintech or who is at scale or e-commerce, it's around 1 to 2%. So generally, that's the in a way biggest lever which fintechs have, and that's why they can sustain and coexist. For banks, cost of funds are minimum, but for any of the fintech or new age player, the operation costs are almost minimum, or let's say one fifth or 1/10 of the overall cost. Also, they have very high agility. I mean, there is no as such called bureaucracy in these companies where one has to wait for any kind of decision and lose the opportunity. But for banks, many a times, even if they want, they are not able to take any call because there are sets of approval and all those things which needs to be done. And in that period, probably many of the opportunity can be lost. So that's one of the slide which I wanted to show that how one can think that why fintech or bank can coexist or one can kill the other. Actually, no one can kill the other if people are following a discipline. But all the parties can coexist. It's a huge market. It's never one market, one person takes all. Different companies will have different kind of mode, and they can serve different kind of customers. Yeah. So, as I was saying before, why fintechs could come into the picture even if the banks had so much of previously, in a way, early move, for the lack of better word, I will say early mover advantage. Still, fintechs can come and can in a way penetrate in this market. Uh, they try to do many innovation other than tech and time to serve the customer, convenience to customer. Those are in a way why customer can get attracted. But in a way, money movement wise, the fundamental innovation which they did is trying to solve basically credit period scenario. So they started putting money on short-term lending. The lending periods were very high. Banks generally were not very much attracted with short tenured loans. So these players get into that. That helped in to them in different way because the same money is circulating and they are able to serve to multiple customers. In addition to that, if you will see, for most of the bank, due dates or repayment cycles are generally fixed. Many of the fintechs have innovated that customer can have multiple due dates. That especially helps a lot to MSME because for salaried, generally it is okay, salaried class segment. But for MSME, they might be getting money at different time. Their cycles may be different. So the companies can also, in a way, innovate that one customer can, let's say, repay their loan on 5th, the other set of customer can repay on 10th, the third set of customer can repay on, let's say, 20th. So in that way, they again, the same money is in a way, some part of money they are getting back on 5th, which they can again lend. Some part of money they are getting back on, let's say, 15th, which again they can lend. So that way money circulation becomes very easy for them. And that is one of the reason I'm very bullish that all these companies can coexist if they follow financial discipline. If they don't follow financial discipline, then yeah, somebody will die. Now let's talk about how different kind of banks, while doing lending, earns the money. So direct interest is no-brainer. If any one of you would have tried to take loan, you know that banks charge some loan. The second point is subvention. That becomes very important. And that is the one of the biggest levers which you would have seen for different kind of new fintech players. The word which you would have heard is zero cost EMI. In that, what happens is, although you are not paying interest, but the merchant who are selling the product, they give some kind of cut to the bank who is giving the loan. So, and why, let's say you're trying to purchase something from Flipkart and you are opting for zero cost EMI. In that case, basically, let's say FREO is giving you zero cost EMI over there. How will FREO earn? Flipkart will do, so because I am lending to people, Flipkart will see higher sales. And since they will see higher sales, they will have economies of scale. And because of that, the inventory cost, which is tied up right now, so let's say they have multiple go downs where things are kept. For that also, they need to pay the rent and all the product which they have purchased, which is not being sold. For that also, they need to incur the cost. But if, let's say, because of lending, people are buying more, then that tied up inventory can be sold in the market. So because of that, what will happen? Flipkart will pay me as an PREO 4 or 5% in that, but to consumer it will cost the same, which they would have purchased directly. So Flipkart is getting more sale. I am earning from Flipkart, and you as a customer do not have to pay a lot. So that is what is called subvention in general. And that is how all the zero cost EMI which you would have seen in the market actually works. Then there is late fine if somebody is not repaying you on the time. Now, as I was talking, what are the advantages and disadvantages of different kind of company? I think we have missed some header over here. So advantages of fintech, especially I was trying to talk about in this slide. What are the advantages which fintech or new financial institution gets? So, I mean, since this industry is little bit less regulated, the fintech segment, you still get more chances of innovation, doing different kind of innovation in terms of data or product proposition. For example, you would have seen some simple lazy pay. They are working with 15 days product, but any bank can't do that. None of the bank can do 15-day lending. So those and you know the benefit I've just explained. What are the benefit if somebody is only lending for 15-day kind of product? Similarly, on repayment, one can do different kind of innovation. Like, when should I try to hit someone's bank account so that I can get the money back? Probably for, let's say, businessman, probably I will be hitting on 15th. For a salaried, probably I will be hitting on first or second. So this is more from the business side. What are the advantages one can have? Uh, Again, you can provide different kind of product features because Most of these fintechs are tech first. So again, creating any new things becomes very easy and becomes very useful for customers as well. One of the important thing is when somebody is doing lending for some kind of purpose, then automatically the credit risk goes down because people want to have that utility. For example, when Ola was doing lending for the rides, although it is called postpay, but in the postpaid, but in the back end you will see that Ola is in a way giving you loan which you are paying after 15 days. So if customers, let's say, are only able to use that loan for the rides, first of all, they can't use that money for any of the derogatory use cases, for example, betting or gaming or all those cases. They once they are using only cabs, then only they can get the money. That also serves sometime as a mode for repayment. So if you are not repaying, I will not let you use the utility. Similar goes for all the electricity department. So all the electricity department is in a way doing lending to you. First, you use their services, and then at the end of the month you have to repay. So if you are not repaying, they are just disconnecting your electricity, right? So electricity connection. So any lending, if it is being attached with some of the utility which customer needs, helps a lot in curbing credit risk. So that becomes very, very important. If somebody is thinking about any new startup, one should always be thinking that collection as a mode. Here, the example which I gave is collection as a mode. I will be mostly getting money because people need cab in future. Uh, One of the important thing is cost of learning for new financial institutions are very low. Why I am saying that? Because many of the big bank or big brands, sometimes they don't want to get into the smaller segment. Why? Because they have associated themselves with very high ticket lending and they think that if I will go in smaller ticket lending, then my branding might deteriorate and people might think that I'm lending in subprime segment and not very prime segment. So generally they don't venture into it. At the same time, let's say even I am trying to give loan to student, I can give loan of small amount. The people who are paying, I can again give them loan, let's say 500, 5,000, 1,000, sorry, 10K kind of loan. But banks generally can't do it. They have associated themselves with some kind of branding activity. I mean, they can do it, but they generally don't do it because of that branding mismatch scenario. The One of the another advantages, most of fintech try to have zero manual intervention. And what happens is if you allow lots of manual intervention, then many a times even employee fraud happens. I'm not sure you guys are aware about it or not. Credit Float was one of the company which has faced a lot of employee fraud, where some of the employees got to know how once Byju's application can be approved, and the same information is being applied by multiple of the user manually, and then that debacle happened that Credit Float saw lots of losses. The major disadvantage is cost of fund. So obviously, many of the new fintech or smaller fintech or new financial institutions don't have access to CASA, the CASA which I have just explained. So for them, they borrow, the financial institution borrow from some other financial institution where they get that money at 10%, 12% interest rate. So it becomes difficult for them to serve at, let's say, less than 15, 20% interest rate, because they also need money to run the NBFCs or fintechs also need the money to run their business, the employee cost, the real estate cost for office and all those charges which are involved. And many people even don't repay, so that cost also need to be incurred by the fintech, right? So this is one of the biggest thing. All others are in a way smaller. Probably you would have read that. We can go forward. Basically, I will be covering how generally decision making happens in overall scenario. Uh, so I think Aditya asked me that many of the companies, since credit scoring is very important, and even if somebody has very high CIBIL, but still companies or banks ask lots of document. So yeah, you're right. You can see the right side picture. So these are the three fundamental pillars of lending. Every company wants to assess intent to pay, ability to pay, and contactability. So intent to pay is in a way nothing but some kind of in a way fraudulent scenario. Are you fraud or non-fraud? Will do you have option? If I will give you money, will you in a way play around with me, or you will like to repay me? Ability to pay is nothing but let's say a person is earning 10K per rupee per month, uh, and his household expenses, let's say at 8K, I can't give somebody loan of more than 2K per month. Will explain. And so yeah, I think Smita is asking what is underwriting. Will explain. Please have patience. I will talk about that. Mm. Then contactability, that becomes very important. That's why somebody does the KYC and all those scenario. If somebody is not repaying me, then how should I reach out to that person? And how will I get my money back as a financial institution? So the many information which the companies are asking to you are in a way aligned with this. So to certain extent, intent to pay is totally covered by your credit rating agency and whatever score you have get. But one does not know, even if you have full intent, but because of any reason, let's say one is earning 20K per month, but had taken loan of 1 lakh in a month, they can't repay in the next month. So that's why generally most of the companies ask for income statement, salary statement, and different kind of such details. Contactability, obviously they try to do KYC, and many times they ask such questions as well, that how many people are staying with you, who all are you married, unmarried, do you have kids? So with that, they are trying to assess that how much will be your expenditure. So so if you are earning 20-30K, but your expenditure is also 20-30K, then your capacity to repay is almost nil. So for me, it will become very difficult to lend it to you. So that's why they try to assess all those things while lending. Now, uh, let's focus on the left side of the picture, where we are trying to cover life cycle of lending. Uh, where so majorly all of the companies follow this part: underwriting, life cycle management, collection. So whenever customer comes, they apply to you with your portal or whatever manual way which is possible. At that time, you try to assess the customer's application. And when you say assessment, that assessment process itself is called underwriting, where I am trying to understand all the three part which is listed on the right side of the figure. And can I take the risk on somebody or not? Basically the credit risk on somebody or not. Will that person be able to repay me or not? So in a way, I as an institution has also taken money from someone. It's my duty to return it back. So I am also assessing my money forward. That can if I give the money forward to someone, will that person be able to repay me or not? That's the in nutshell. That's the process. Then to do that, you do multiple things, like you try to understand customers' income profile, the KYC details, the spend pattern of customer, and if there exists past repayment behavior, meaning if you have already taken some loan from somewhere, then are you repaying on time or not? with the help of that, all the credit scores are created, the CIBIL score or CRIF score you would have heard of. So, basis all this information, there are different kind of forecasting models which are built by companies using AI or ML, and that in a way forecasts that customer will pay me or not pay me, basis that they accept or reject your application. Once the, let's say, customer has got the money, now they have started repaying or they are interacting with my product, then it becomes then the customer's life cycle management becomes very important. So for example, if customer needs more money, why should he or she not take from me if the credit risk allows that? The person should not go away from me, because uh, once underwriting gets cleared up and customer starts repaying, my fraud risk becomes zero, because now I have established that this is the customer and he or she is repaying or not. So can I give the customer more loan? That is what is called upsell. Or can I sell some other product? For example, you have taken credit card from me. Can I give you home loan? Can I give you car loan? Or anything of that sort. So once you are repaying me on time and all your behaviors are very good with me, I would like to give you upsell, cross sell. Even in credit card, probably today you have got 1 lakh or 2 lakh or 5 lakh credit limit. Tomorrow you might get 5-7 lakh credit limit as well, so that customers don't go away from me and I can keep on getting overall life cycle or lifetime value high from the customer, because I have already invested a lot while acquiring customer. I have incurred cost of marketing. I have incurred cost of KYC. Probably many of the customer would have done some amount of fraud as well. None of the company is fraudless. Every companies face huge amount of fraud. So that money has also gone. So the customer who are there after all those cleanup, I want to retain them and want to serve them well as much as I can with all my product portfolio. That's what is called life cycle management from company perspective. The people who do not repay, then collection calls or collection work start. Different companies have different kind of collection ops team who starts calling, then also in a way explains customer that if you won't repay, what could be the repercussion. Then sometimes people go for manual visit as well, that can I get money or not. So in each of the step, basically you also understand that whatever action I'm taking, what is the impact of that, and is it useful? Am I getting my money back or not? And these feedbacks are again passed on to underwriting team or life cycle management team, that don't give a loan to this such kind of customer who are not repaying. For example, people from certain area, most of the time when I'm going for collection, people are threatening me for life. So let's not at all give the loan in that particular area. So those kind of feedback you get from collection team or life cycle management team, and then you try to incorporate in your underwriting policy and try to give the loan. Probably I have answered your question. In general, how does the overall underwriting process work for company? If anybody has, in a way, aspiration that to work or in any of the fintech or banks, this will help the overall process flow, how it works in any of the company. Uh, let's say because of I have a portal or I have an app, or let's say I myself is already a e-commerce player, then I have a customer base or somebody is applying to me. Then the first step which any of the companies try to check is fraud rule. They apply different kind of fraud rules through which one can capture the fraudulent users. For example, might be I asked you for income proof, you might have forged that, and I with my system I can capture that you have defrauded me with your income statement. Then I will reject you directly over there. Once the customer do not gets captured in any kind of fraud rule, then there are set of policies which are applied. For example, you would have heard that RBI has mandated that none of the financial institution can give loan to willful defaulters. So yeah, even if you have money, then money in the account, for example, Vijay Mallya can't get loan in India, although he has left the country as well. But even if he comes and not get caught in by the police, still if he will apply, he will not get loan as per the RBI policy. So such kind of rules you apply. Many of them are, let's say, regulatory in nature. Many of them are specific to the company. For example, a company might say that I currently want to work only in Bangalore or not want to work outside Bangalore. So any applications coming from outside Bangalore, I might reject. Or it is true for any of the Indian financial institution. Many a times you see some of the applications coming from Bangladesh or Nepal. You can't basically give them the loan. It is not allowed as well. And even if you give them loan, some if they default, you will not be able to recover that money. So yeah, post that different kind of companies have different kind of underwriting model framework where they try to predict the probability of a default, that customer will pay me money or not. Then basis some such cutoff, they accept or reject, and then they keep on then they approve, and then they regularly keep on checking that through different kind of reports, see that whatever decision they had taken in the past, are they getting money back or not? Is the company profitable with the such kind of strategy or not? And wherever the tweakings are required, they again change it. Uh, I think, yeah, in general, this is the normal life cycle of any of the decision model which any of the company make. Since the company, if the company, let's say, starts new, they do not have much of data, do not have much of learning. So most of the things are generally made by rule or hypothesis driven or expert driven, who then they in this in between they make a very preliminary model through which they do underwriting. Again, they try to create similar kind of score like CIBIL or CRIF provides you or Experian provides you, and through that they try to make the decision. Post that, since companies gets lots of data, forecasting becomes easier, and then also for any kind of AI or ML models, you need a huge amount of data. So once they have that, they go to that decisioning. And that is how, in general, the underwriting intelligence improves and go forward. This is very important. If somebody is in learning, it becomes very important to understand why somebody defaults. Uh, mm, if you will just read that this picture from left to right, the greener the segment customers actually default meaning people are not paying me on time. For a financial institution, default meaning somebody is not paying me on time. So normal reason is the customer uh, tried to repay, but because of tech bug or something, they are not able to repay, or the customer has forgot, or there is some emergency in customer's life. That's why they are not able to repay. The third part which you see, deterioration in financial health of customer. For example, customer has lost the job, or maybe the business got shut down. Although customer has all the intent to repay, but he or she is not able to repay. Uh, After that, many times product awareness is not there and long-term repercussions are not known to the customer. This happens a lot in young kids. They think that I have got the money, and even if I don't repay, nothing will happen. But you are certainly aware that there is a company, there is a data aggregator which is called Credit Bureau. In this case, you would have heard about Civil TransUnion, or many other. There are four credit bureaus which exist in India. All these banks report about your default to this credit bureau, and any of the financial institution which they are giving, trying to assess you to give the loan. They check with that data that have you defaulted with someone or have you not repaid with someone or not. So sometimes because of less awareness, many customers just default and take it lightly. If they would have been aware about the repercussion, probably they would have repaid. The second last is sometimes customers' product proposition dies. For example, many of the people do this, that let's say I have taken ICICI credit card. Now I have planned to move to US. I'm sure that I'm not going to use ICICI card. I will use the entire limit of this month, and next month I will be flying to US. So because this card, I'm sure nobody is going to catch me in US, and such kind of scenario happens. Many times there are many disputes because of which customers don't repay. Many times you would have seen that credit card companies don't explain you that these are the charges which can be incurred on credit card. That's why customers are not aware and they think that I've been charged a lot, and then they don't repay. And the last and very killing thing for any of the company, fintech or uh, any financial institution is already fraud. So there are, you would have seen Jamtara series, you know that which kind of fraud can happen. And in that case, financial institution suffers a lot. So that becomes very important. And when you are devising your strategy, which was shown in the last slide, one have to think about all these reasons, and then only they have to devise different kind of fraud rules, policy rules, or predictor kind of scenario.